Okay, welcome back, guys, to another Not Solid Night show. Today we will be talking about a company based in Malaysia, and perhaps if you are someone who goes to the YouTube quite often, you might be very well aware that this is a company that the Uncle Roger has made it pretty famous. I mean, not this company, but the products related to the company. So yeah, for those who are actually invested or investing in the Malaysian stock market, you can actually have the opportunity to take part in the growth story of the company. So the company we will be talking today, it's Ajinomoto, Malaysia Berhad. So of course, I think the question that you need to ask yourself whether is this company currently a company with fuyo, or more of a haya kind of rhythm to it, right? So this is what we are going to explore today, right? And of course, before going into the information regarding the company, we will actually state out as usual our disclaimer. Whatever we share with you guys in this sharing session does not constitute you to buy, sell, or take a position on a share, but rather to just pinpoint you what are the available information out there, what are the facts, and then what are the points that you maybe need to dig deeper and analyze deeper before you actually choose to invest or not in this company lah. So we will straight away go through to the business info, which Chun Beng will actually start it off. So what does Ajinomoto do, and are there products that they are doing that we are not so aware of?
Yep. So I think let me take over. Unfortunately, I don't have an orange shirt, so I cannot do a tag team together with Jupan and pay our respect to Uncle Roger. But nevertheless, let's start off with the introduction of this company. It's basically Ajinomoto Malaysia Berhad. So if you search for the ticker in the KL Stock Exchange, it will be AJI. And then they actually started the business operation back in 1961. And then it's a main distributor of this monosodium glutamate, or in more general, people call it MSG, right? But then Asian being Asian, usually will be lectured by our mom, say not to take so many of the MSG, although MSG did make the entire foods more flavorish. I would say it make it taste better, but of course, some of the people are having some concern, especially on the healthy concern when they took MSG products, right? But then we will go to the next slide and share with you within Ajinomoto's Malaysia Berhad, what is the list of product they are having right now. So you can see majority of their product they are famous with is actually the seasonings product. I think the top left should be the most, I would say, legendary packaging that you will remember lah. Ajinomoto itself, technically you link it to MSG already. It's just like how we Malaysian link Maggi mee into instant noodle. So this is how they actually able to associate themselves to the MSG. So this is something they have done pretty well. But then recently, they also step into two new products category. So one of it is actually the sweetener, and then another one is they also go into the sport drinks. So the sport drinks is actually called Animo Vitals. It's number one Japan's brands, but of course it might not be that well known in Malaysia. So this is something they are trying to picking up and try to pivot to something else instead of just selling MSG products. This is the two new category being offered or introduced by Ajinomoto. And then moving on to the next slide, beside all this product that is actually serving people like me, Jupan, and you as a consumer, they also have the industry products under the brand name of Techno. So basically, for all these industry players who wanted to make packaged food or whatnot, they will use this brand rather than using Ajinomoto's, right? And then the next slide actually gives you a breakdown of how their business is actually performing. So basically, the first one is actually giving you the breakdown by the segment, which is mainly the broken down by the consumer product and also the industry products. And then you can see, of course, the year 2021 is not a good year. A lot of issue mainly due to pandemics, and then of course it hit quite badly into the consumer market. But nevertheless, I think the industry one did quite well in revenue. But if you move on to the right-hand side, if you talk about operating profit, I think it's quite obvious lah. You can see actually the industry products actually give you a better margin compared to consumer product. So these are some of the business breakdown in terms of segment. And then we can move on to the next slide. So this one gives you the breakdown of the geographical footprint by Ajinomoto Malaysia Berhad. Even though it's a Malaysia company, but then they not only serve our local markets, they also export the products to a lot of countries. So one of the big part is actually coming from Middle East and also coming from the other ASEAN country. So you can see actually moving from 2020 to 2021, although you can see Malaysian market and also Middle East is actually dropping, but then the other segment actually doing some small contribution back to it. So this is just a number between 2020 and 2021, right? But you might see, oh, there's a lot of bad result related to Middle East. But then, to be fair, if you zoom the result back to the past 10-year result, you will see actually Middle East is one of the important continents that bring in some of the revenues. It has been growing from time to time, and you can see actually only 2021 the revenue start to actually drop a little bit. Of course, mainly due to pandemic, but the rest is they are growing quite steadily lah. From the chart itself, it's quite obvious. And of course, it's also quite important that they're not only serving the Malaysian markets, because you can see the Malaysia performance is actually started to drop or remain stagnant in the past 2 to 3 years. So these some of the information should take note lah. I mean, the other continent or the other regions definitely helps in bringing the entire revenue story going up from the year-to-year perspective. Okay, so of course, then we can move on to some of the info. If you talk about the top shareholding, so based on the annual reports last year, 2020, more than 50% is actually owned by Ajinomoto Co-In. Right? Of course, this is the mother company that own the brand itself. And then the rest is actually owned by multiple parties. If you talk about just the director itself, it's quite small. The director holding only owned by one fellow, and is only up to 0.25. But all this record is only true until the 30th of July 2020. So because the latest annual report is not released yet, so there might be some changes, but all in all, it should be around the same, meaning Ajinomoto Co-In still own the majority part of it. And then moving on, they also have some expansion plan in Malaysia. So they announced this back in 2019, say there will be a new plant in Seremban, and then they have invested 335 millions. Of course, the original plan timeline to launch is actually March next year, but I mean, there's a few MCO going on, and then it actually causes some of the delay. So the latest information that we have is actually it might delay 3 months, which is to June 2022, but it might delay further because FMCO is still going on at the moment. So these some of the insight, all these things, because it's actually costing them to spend quite a bit of money in the past few, I mean, especially these few quarters. Of course, it might not be able to realize the profit as soon as the original plan, which is March 2022. It might prolong, at least go to June 2022 or slightly longer. So this pretty much sum up what is Ajinomoto Malaysia all about. And then I'll pass to Jupan to continue with some of the number and also chart regarding their historical performance and some of the balance sheet and also cash flow figures.
All right, thank you, Jumbeng. So surprisingly, even though that most of us are quite well aware or, are quite familiar with Ajinomoto's business, they are actually, some kind of initiatives and effort going around to actually improve the current portfolio. Because at the end of the day, if you really study how big Ajinomoto Group is in Japan, they actually have more than just MSG. Their business includes, mayonnaise and other kinds of different ready-to-eat products as well, if it's just in Japan. So it's how they want to, maybe up the game when they actually move to their new plant and actually introduce more than just a ingredient to the market, but also maybe look into other niche kind of product offerings that they can actually grow as well in Malaysia. So that is one of the catalysts that you might want to anticipate. But before that, just based on the last 10 years results for Ajinomoto, very, very stable, very, very, in a way predictable, because food and ingredients, it always will grow in a stable manner unless something is really, really wrong with the product or of the company lah. So if it's a good brand, most people are using it. They have a significant market position in the consumer's heart. Then yeah, it will slowly and eventually grow. But you can also argue from another point of view, it might be a little bit boring, right? So we can see that everything has been in tandem with the revenue growth, the slow, stable growth, but only in 2017, you suddenly see a one-off increase in terms of the profit. This is due to Ajinomoto Group actually sold off a piece of land, which is in the current place that they are operating. So that piece of land, if not mistaken, it's what's the name of the place with Jumbeng? Kuchai, yeah, I think around Kuchai Lama there. So they are going to relocate their plant to Bandar Ansteg, Seremban. So that area actually fetches quite a good profit and return lah. So when they actually sold off, so you will have a one-off profit captured there, and then that one-off profit eventually got reimbursed out to shareholders as a special dividend. Later we also take a look at the cash flow statement. But other than that, if you take away the one-off profit from the land sales, pretty much stable growth, in tandem with the revenue growth. Right, and of course, if you also plot the return on assets and return on equity, you will get distorted by the land sales. So you have a one-off very high sales, but if you just neglect that, it is always ranging around 12-13% for the return on equity, and the return on assets is also roughly the same lah. So you can see that when a company's return of asset and return of equity is roughly the same, that means this company is not actually using a lot of debt. So if the company used a lot of debt to run the business, that means the amount of equity you need is not that much. So when you have a huge profit divided by a small equity portion, then yes, you will see your return on equity actually going higher. So that's why we talk about it before. We can maybe link the video in the top right part, how we actually dissect the return on equity, and one of it is actually the usage or dependence of debt lah. So this is a company straightforward. I would say that there is not much debt, and it's pretty much flat lah for their so-called historical return on assets and equity. And then you can also look at last the cash flow statement. So this is a company, I think, after studying quite a few Japanese companies, I tend to realize or think that there is some kind of weird thing going on with Japanese companies that really like to hold on to cash, right? So you can look at the yellow columns. This actually shows us on the yearly basis comparison how much cash and cash equivalents that company has at the financial year end, right? So you can see it's always on the higher side. Just that come to 2017 up to 2021, it has been flattish, right? It has never gone down below the blue line, which is the amount that the company generated from the operating activities. And of course, the red line also stays below the blue line, which means that the company does not overpay the dividends to the shareholders, overpay more than what it earns, save for the exceptional incident in 2018, which was the year they sold off a piece of the land, the current land that they are operating in on in Kuchai Lama, so you get the one-off special dividend, which actually eclipses or exceeds the operating cash flow. But apart from that, pretty much stable business, nothing to really worry about also, because company is sitting on a huge pile of cash, and straightforward, reasonable good company, right? And also looking at the amount of the money that the company is actually spending on its capex, you can see that starting from 2020 until 2021, the amount is actually going up, because there's a lot of transporting machineries and equipment from current place to the new place in Seremban, and also maybe they also took the opportunity to enlarge the capacity of their plant as well. So that is the amount where you can see that the company is spending more on the capex, right? Previously, it was just a very normal, stable growth, but hopefully, fingers crossed, depending on what the company wants to, strategize for its next growth prospect, the amount of cash that they're actually investing in right now is not a small amount, right? So this is what we want to actually take a deeper look in the coming near to middle term, to see what the company's plan is up to, because they really actually invest a lot into the new plant. And last but not least, if you check back the dividends paid out, it has also been in tandem with what the company has been achieving, just for exceptional case in 2018, where the one-off dividend from the land sales profit, so that actually came out quite a lot, right? It's actually around 4 times more than the usual amount that we pay. So last but not least, I think this is a very simple company. We will go into the valuation portion, but before that, just a little sharing on what we actually do for Kaya Plus Premium Club. So actually, we do have a subscription service where we actually invite like-minded people to a Facebook group where we discuss on stocks, and then we also share good articles on companies, be it in Malaysia, Singapore, or around the world as well, right? Of course, there's also some sort of private sharing session with interesting topics to the subscribers, and of course, those who have actually enrolled in Stock Plus 2021, 2022, we will also do the same thing, pick 10 stocks that we think will flourish for 2022 and onwards, right? And of course, there will also be premium analysis and articles, and also sharings and webinars on special themes as well, right? So this is just a snapshot of what we have been doing. And of course, they will have premium articles and analysis right here. And we will be also doing thematic sharings on semiconductor, which will be happening by end of next month, right? So for those who are with us with the Kaya Plus Premium Club, you get free access. And for those outsiders who are still interested to join, the fee is just 199. And here you have it. If you are interested, do book your calendar on the 24th of July at 10 a.m. It will be a whole day event. And I think we will also include the sign up links in the description box. And this is just a snapshot from the integrated device manufacturers all the way to the end stream players. And this is a snapshot of what we have done and covered for previous session on electric vehicles. Right, perhaps I'll bounce it off to Bing. What do you think about Ajinomoto Malaysia, Berhad? I mean, stable business, reasonable valuation, and reasonable dividend yield for you?
Now, I think, of course, if you zoom into 2021 performance, you'll see a lot of red flag. I mean, in terms of revenue, it's not showing growing sign, but of course, a lot of it is due to pandemic. The factory forced to lock down, stop from operations. It's all these factor. I think bear in mind, I think Japan brought a good point that we should take note is when they moved to Seremban, when they plan to let go the piece of land in Kuchai Lama, I think it might have another impact back in 2017 or 18, the one-off effect. Of course, this is something that it might come, it might not come. So better don't put all your bet because of this, right? But of course, nevertheless, in the past 10 years, it has been always stable, quite stable, keep on growing up. That's why I think it's quite reasonable at this I would say in this kind of PE, because the growing potential is still there, due to the consistency that's being demonstrated by Ajinomoto's, right? But of course, I think personally, me myself, it's not a fan of MSG, right? Although I like delicious food, but of course, I think me myself, if I go to grocer to do shopping, usually I won't buy MSGs for my own home cooked product. But nevertheless, I think the requirement is definitely there because it will be taken by a lot of commercial cooks. I mean, be it from hotel, from a coffee shop or whatnot. Definitely, MSG is one of the key thing to, like how Uncle Rogers said, to maximize the taste of the food. I do admit that it really tastes better, but of course, this is some of the takeaway lah. I think quite straightforward, nothing much to take note beside the new plant that's going to launch next year. And also, in terms of dividend, I think it's quite consistent. The past few years is always giving out about 50% from the profit itself. So if you are people look for stable returns, then probably Ajinomoto will be your cup of tea lah.
Yep, I think so too. So I think just to wrap it up, of course, there are still a little bit of obstacles that Ajinomoto Malaysia needs to overcome. Right? I mean, you can see even from Chun Bing, even for me, I think the newer generations we seldom buy Ajinomoto or buy MSG as an ingredient to cook back at home. I mean, the older generations like my mom, my grandmom, yeah, they do have Ajinomoto as an ingredient by the by the wok where they actually put some of it every time they do cooking. But I think the newer generations might be a little bit more health conscious, and hence if Ajinomoto would want to grow, it has to be from another avenue, right? Food service, hotels, as what Chun Bing say, and maybe manufacturers as well, and also could be bringing in more relevant products, ingredients, extensions that they have so much in Japan and try to reintroduce into Malaysia, and hopefully there will be some renewed kind of interest from the normal or the newer generation consumers to actually consider, okay, I can actually buy mayonnaise from Ajinomoto brand because it's a good brand. And just that I don't use MSG, but I can actually consider buying the Japanese mayonnaise under the Ajinomoto brand. But of course, until that kind of growth story or that kind of marketing comes in to reaffirms that there is a new growth frontier for Ajinomoto, we also want to take note that what the amount that they invested into the company is not little. The amount that they invested in Berhad is a huge amount, and it's always good to keep a lookout and be active to see that what are they planning to come up with next for their next growth plan. So if it really comes up, then yeah, the valuation is actually priced. It's not priced in for the growth, and you might enjoy more upside. But other than that, if it's just flattish with no prospects, then yeah, maybe it would just be a potential value trap. So since the company has seen its share price coming down from 2018 until 2021. So I think this is a very 50-50 ball game. You really need to be very confident that company has a game plan to grow. Otherwise, it will stay flat, most presumably for a long period of time. So I think that's it for today. It's a simple, straightforward company. And if you really enjoy this simple sharing on Ajinomoto Malaysia, Berhad, do let us know in the comment section what company you want us to cover next. And yeah, I think that's about it. We will see you in the next episode of our Not So Late Night Show. Take care and bye-bye.